Of course, a Reserve Bank interest rate decision day. And, well, the RBA might have left interest rates on hold, but make no mistake, there are still plenty of interest rate moves out there. Last Friday, for example, the Commonwealth Bank raised rates on its packaged home loans. That was out of cycle. A week ago, the ANZ did the same thing for its basic mortgage. But refinancing of mortgages right now is at record levels as borrowers seek relief from the rate rises. So let's bring in here Sally Tindall, the Research Director of Interest Rate Monitoring Group, RateCity. Always good to have you here on these days, Sally. Here's the point, rates are on hold, but rates are going all over the place at the moment because the banks are having to compete for more market share.
Oh, absolutely. All over the place is a really good way to explain it because most lenders are fighting tooth and nail for that now almost $20 billion a month pie that is refinancing. The latest ABS figures that came out, yesterday, they showed that refinancing was about $8 billion or there or so. This is a huge amount of money at play here.
Because what happens is if you're on a fixed rate mortgage, you're coming off it, you're immediately going out and saying, I do not want to face into basically 3.5% extra interest rates that have come. You want to get a better deal, and so you're hunting.
And they're moving, which is fantastic to see because it puts heat on the banks to keep competitive. Where we are seeing the cracks appear is with CBA, ANZ and NAB, as you mentioned, they all lifted their new customer rates. It was only for
Why would you raise interest rates when you're trying to build market share? Why would you raise rates for new customers?
It's a really interesting equation, but what they're basically saying is that and Matt Commons said it in his half-yearly results, is that they're at the peak of discounting. They cannot move anymore. There is wholesale funding pressures piling on them like a ton of bricks.
So in other words, if they write new loans and try and keep up with others in the marketplace, they're effectively writing unprofitable loans. That's what they're saying.
That's what they're saying. And so they've taken a step back. It's just a small step back. But interestingly, we've seen from all of these banks is that they're now really focusing on ideal customers. Those customers with a 40% amount of equity in their loan or more, they're offering the sharpest rates there. So in the case of CBA on their package loan, it was 5.32%. And then on Friday, for those people with 40% equity, it only went up by 2 basis points, 5.34%.
OK, this also comes because even Westpac, its boss Peter King in the past week has said, look, at the outer margins of their home loan portfolio, the stresses are starting to show after these 10 consecutive rate rises.
Oh, absolutely. A lot of families out there are actually feeling the heat. This is the whole reason RBA wanted to pause because most borrowers are only up to their 8th rate hike. They haven't felt the full impact of the 10. The RBA can already see that some households are feeling this really significantly. They're worried about what will happen if they pile on another hike without having a pause.
OK, so what is the difference between the rack rate that the banks would charge you if you walked in and didn't haggle versus the best you can get in the market? Because that's where you can make the big saving if the banks are prepared to play with you.
Oh, absolutely. OK, so we think that the average owner-occupier who hasn't haggled is on 6.36 at the moment, 6.36% that is.
So 6.36%, but let's be honest, you have to be a bit nuts to be paying that.
A little bit. And so the big four, they're offering around that 5.4, 5.5 mark in some of their sharpest rates. Westpac's a little bit lower. But the absolute sharpest rates, we've got 7 lenders still on our site offering variable rates under 5%. 7 lenders to choose from.
OK, so they're not bad lenders because, let's be honest, if you borrow, you're the risk, not them.
Absolutely.
So therefore, you'd be kind of like, while they've got that pot of money out there and eventually it evaporates and it disappears and they've got to finance at higher levels, you'd almost be crazy not to take that money versus paying high fives, mid fives for the big banks.
Now is the time to take advantage of the competition in the market before it disappears. We can't guarantee that it's going to stay around for, forever and a day. It might not. And so take advantage of that competition now. Yes, you might have to move to a lender that you haven't heard from, but heard about, but as you said, Ross, the risk is on them. They're borrowing you the money. Yeah. We saw, say, for example, Nano, a relatively new lender in the market, they folded. But what happened? ANZ bought their home loan book. The customers transferred on to them. My understanding is they're on the same rate. So it's, it's not a huge risk that you're taking here. OK, so then one very final one for you, and that is there's all this competition out there. People are trying to get sort of some small advantage out there. The competition, if the big banks withdraw from the competition, as some of them appear to be trying to do, then what happens to the rest of the marketplace? Oh, look, I worry that the rest of the marketplace follows, and that's why I say refinance now while there is still heat in the market, because But sometimes we see all too often when the big banks move, everyone else follows in their wake.
Yeah, it's going to be interesting to watch that. Sally Tindall, always good to have you on from RateCity. Many thanks for your time today.